Albert Einstein may have had his theory of relativity, but he believed that the rule of 72 was an even more important discovery. This rule, first mentioned by Luca Pacioli, the father of accounting, in his 1494 book Summary of Arithmetic, Geometry, Proportions and Proportionality, is a powerful tool for understanding the power of compound interest. Imagine being able to double your money in just a few short years. It's a dream that many of us have had at some point. How many times have you wished upon a falling star for a bank account with 6 figures? Well, the good news is that this is possible, and it's not just a fantasy. In today's video, I'll be delving into the rule of 72 and showing you how it can help you reach your financial goals. To calculate the rule of 72, divide 72 by the rate of return you hope to earn. For example, if you plan on earning an interest of 5%, divide 72 by 5, which will give you 14.4. This is the number of years it will take you to double your money. One of the major advantages of this rule is that it allows you to quickly and easily determine whether you are keeping up with trends and making sound financial decisions. Additionally, it can be used to calculate inflation by showing how many years it will take for the value of a starting sum to fall in half, rather than double. However, there are some limitations to the rule of 72. It can only be applied to assets that calculate compound interest annually, and it can be less accurate for rates below and above 6% and 10% respectively. Despite these disadvantages, it is still a useful tool, and it's recommended to consult with a financial advisor who can explain the rule in more depth and guide you in making the right decisions. Compound interest and the power of time. One of the most powerful tools for achieving financial growth is compound interest. As we've discussed, the rule of 72 is a quick and easy way to determine how long it will take for an investment to double, but it only works with compound interest. So, what is compound interest? Simply put, it's the interest earned on your initial investments that is added to your initial investment, creating a compounding effect. The longer your money is invested, the greater your earnings will be. For example, if you invest $1,000 at a 6% interest rate, after 12 years, as determined by the rule of 72, you will have doubled your money to $2,000. But if you continue to invest and earn interest for another 12 years, you'll have $4,000, and so on. The key to making the most of compound interest is to start early and invest for the long term. The longer your money is invested, the more time it has to compound and grow. Additionally, look for high-interest investments that will accelerate your growth. The rule of 72 is a useful tool for evaluating your investments. It can help you determine how long it may take for your money to double, depending on the rate of return on your investment. To better understand this rule, let's examine 4 different investment scenarios. A savings deposit with a 1% annual rate of return. Government bonds with a 5% annual rate of return. Mutual funds with an 8% annual rate of return. Stocks with a 12% annual rate of return. By using the rule of 72, you can calculate how long it will take for you to see returns on these investments. Also, if you're enjoying the video so far, please take a moment to give it a like. The rule of 72 can also be used to understand the impact of inflation on your finances. Inflation is the rate at which prices tend to increase over a certain period of time, which can make it more expensive to buy the same goods and services you purchased in the past. The rule helps us determine how long it will take for prices to double at a certain inflation rate. For example, if inflation averages 3% per year, the price of goods and services will double in 72 divided by 3 is equal to 24 years. However, if the inflation rate is 6.8%, prices will double in just 72 divided by 6.8 is equal to 10.6 years. By using the rule of 72, you can plan ahead financially to stay ahead of inflation. The rule of 72 can also be applied to your savings goals. By understanding how long it may take for your savings to double, you can make informed decisions about where to keep your money and how much to save each month. Keeping your savings at home can be risky and easy to lose, while investing in the stock market has the potential for higher returns but also higher risk. Opening a savings account with a bank may offer a lower return of 1% interest. To make the most of your savings, it's important to set a goal and budget for how much to save each month. However, using the rule of 72 can help you understand how long it will take for your savings to double and make adjustments to your plan accordingly. The rule of 72 is a quick and easy way to estimate how long it will take for an investment to double. For example, if you have $1,000 that you want to save in the bank earning a 1% interest rate, it would take 72 years for it to double. However, there are many investment programs that offer a minimum interest rate of 4 to 7% per year. By doing some research and consulting with a financial advisor, you can find a much better return on your investment. The Rule of 72 is a useful tool for estimating the amount of time it takes for an investment to double. Using the example of $1,000 invested in a savings program with a guaranteed interest rate of 5%, it would take 15 years for the investment to double. This is significantly less than the 72 years it would take at a 1% interest rate. Remember, 5% is just an example and realistic rates can be even higher. The Rule of 72 can also be used to understand the impact of inflation on your savings and to plan for the future. The key takeaway is the importance of being patient when it comes to investing. Don't wait any longer to start your journey towards financial freedom. Utilize the Rule of 72 to make informed decisions about your investments and plan for the future.